In this video, I look at where to invest in 2024, which countries, which sectors, gold, bonds, or other asset classes. I'll also provide an overview of valuations across stock markets. And of course, it's forecasting season, so we'll poke some fun at some broker forecasts to look at how well they performed in the past. And we'll also look at what they're forecasting for 2024. Now, don't forget, if you do enjoy our content, please do like this video and subscribe to our channel. So now let's look at where to invest in 2024 in a bit more detail. Let's begin by looking at US equity valuation. One interesting measure to look at the moment, because it adjusts the real interest rates, is the excess CAPE yield from Robert Shiller. This takes the CAPE measure, the cyclically adjusted price to earnings multiple, which is the price of the index divided by the earnings over the previous decade. Then it inverts that measure and it subtracts the real rate of interest. This captures the intuition that if interest rates are low, then people should be willing to pay more for stocks. Now, for a long time, the CAPE measure showed that stocks were overvalued because it wasn't adjusting for very low interest rates. However, people were saying it should adjust for that, so this is why Robert Shiller came up with this measure. However, now that interest rates, real interest rates, have surged upwards, it actually makes stocks look expensive again. And that's because stocks haven't re-rated downwards to adjust for that higher real rate of interest. So what I've done here is on the x-axis, going back to the 1800s, late 1800s, I've shown the starting point for this excess CAPE yield measure. And then on the y-axis, what you can see are the returns from the US stock market, the S&P 500, over the following decade. And that's the total real return on stocks, inflation adjusted, and reinvesting dividends. So as you'd expect, when stocks are expensive on the left-hand side of the graph, that's when you tend to get the lowest return over the following decade. And when stocks are cheap, that's on the right-hand side of the graph, you can see that then returns tend to be higher. But there's a lot of noise in the graph. It isn't a perfect predictor, far from it. And usually it's most informative at the extremes of the distribution. And currently you can see that the US is looking expensive by this measure. So if we slice through the distribution, that's the dashed yellow line you can see, given the current value of the excess CAPE yield, you can see that that tends to give lower returns, although it's not such an extreme valuation that you'd get very low returns. So really all we can say is that currently US markets are quite expensive, and that tends to be a slight drag on the following decade of returns. If we look at that excess CAPE yield measure over time, you can see when it's expensive, that's when it's low, and when it's cheap, that's when it's high. So red is expensive, blue is cheap, and currently it's getting into expensive territory and gradually creeping deeper into expensive territory. As I say, this is because stocks have not re-rated downwards to reflect new, higher real interest rates, or at least they haven't re-rated downwards sufficiently. Another common measure of valuation for stocks is to look at forward price to earnings multiples. This is based on forecasts of what stocks are going to generate in the S&P 500, and then it's a kind of bottom-up estimate which looks at the 500 stocks in the S&P 500 and aggregates up to the index level. So make no mistake, this is based on a guess of what profit stocks are going to generate in the S&P 500. But what's good about this measure is that it's forward-looking. It's based on what brokers expect these companies are going to generate, and presumably they'll factor in everything they know about economics, also what they know about those single stocks. Now, normally this makes stocks look cheap because brokers tend to be quite bullish on their broker forecasts for profits. And we're dividing by a big number, so usually that makes stocks look cheaper. However, at the moment, that measure too is looking a little bit toppy. It's above the 5-year average, which is the dashed green line, and it's above the 10-year average, which is the dashed blue line. Now, of course, this is a mean reverting measure. You don't expect this to trundle upwards forever. You'd expect it to come back to a long-term average. So by this measure as well, US stocks are looking quite expensive. To be fair, nothing like they were in 2020 following the pandemic rally, however, still a bit expensive. So now let's dig into those US profit forecasts, or US earnings as they're called. So this is that bottom-up estimate based on forecasts for the individual stocks in the S&P 500. And what this graph shows you is how that forecast has evolved over time. The yellow line is the current forecast and the blue line is what actually happened in the past. Now on average, US earnings tends to grow by around 6% real over the long term. And you can see that there was a big dip during the pandemic. There was a huge surge back upwards in terms of profits following the pandemic. Then we reached a kind of hiatus point where growth in profits seemed to stabilize. Now we seem to be going back to that trend growth as we move into 2024. So if instead of looking at the level of profits, we look at the year-on-year change in profits, the red bars here are the forecasts, the blue bars are what happened in the past. You can see that we've had 3 successive quarters where there was negative earnings growth. In other words, profits were falling year on year. However, the forecast is that that growth in profits will come back in Q3 of 2023. It'll weaken slightly in Q4, but then in 2024, we're seeing some really quite punchy year-on-year growth in profits. What that means is that if there is a rally in stocks over the next 12 months, say, then it will be backed up by a fundamental growth in profitability for US companies. So this is reassuring to see that we've gone from a period of weak and negative earnings growth to one in which there should be, hopefully, positive and accelerating earnings growth. Now, of course, the big story of 2023 was the dominance of the Magnificent Seven. These are 7 stocks which utterly dominate the US market. These tend to be tech stocks, although the individual sectors aren't all classified as tech. Tesla, for example, is consumer discretionary, for example. So's Amazon. But the question is whether the fundamental profit growth of those companies justifies their huge dominance as part of the S&P 500 and the Nasdaq. And the answer is yes, but only partly. So the Magnificent Seven make up about a fifth of the S&P 500 forward profits, looking a year ahead. If we look at the top line, the revenue generated by those companies, they only make up about 11% of S&P 500 forward revenue. Why the difference between the two? Well, these tend to be companies which have very high margins, so they turn revenue into a loss of profit. But what is worrying is that they make up about a third of the S&P 500 by market capitalization. So the size of the companies as a proportion of the index is not in line with the proportion of profits which they generate for the index. If we look at that graphically and go back to, say, 2013, it was the case in 2013 that profits were in line with market cap. However, over time, what you can see has happened is that gradually these companies have baked in more and more euphoria, and generally investors are paying more for a fixed amount of profit than they were in the past. Now, ultimately, that will be unsustainable. So this concentration in just a few stocks is probably unhealthy, as many people have pointed out. However, how long it takes to correct itself remains to be seen. And certainly these are companies which are very profitable, very successful globally. However, I think this concentration is unhealthy, and I think ultimately it's not fully justified by the amount of profits that these companies generate. Now let's consider country valuation for stock markets. So what we're looking at here is a cyclically adjusted price to earnings multiple. This is the price of the index divided by the profits generated over the previous decade, and this is the measure produced by Robert Shiller. And here what we can do is compare across different countries. Now, some countries are typically very cheap, others are typically very expensive. For example, the UK is typically cheaper than the US, and that's been true for a long time. So instead of comparing multiples directly with one another, what I've done here is to look at each country and ask a very simple question: what proportion of the time has this country been cheaper? So, for example, India has been cheaper 87% of the time, going back to when records began for that stock market. The Netherlands also has been cheaper 87% of the time. The US 82% of the time. So those 3 countries you can see on the far left-hand side of the graph are the ones which look very expensive relative to other countries. In contrast, Singapore, China, Hong Kong, South Africa, and Poland are looking particularly cheap right now. And that's compared to their own history. China, for example, has only been cheaper 2% of the time. Poland only 10% of the time. So if you are feeling particularly brave and you're a contrarian investor, then typically you'd look at these cheaper countries, which are usually cheaper for a reason, and think about whether that represents an opportunity. And often it does. And probably you'd keep away from countries which are overvalued. But you'd probably have to do this for more than one measure. This is just the CAPE measure. And that way, by using a broader set of measures, you'd have a better idea of which countries are expensive and which are cheap. So if we look at those CAPE multiples over time, this shows you the point I was making about some countries typically being expensive or cheap relative to one another. What I've shown here is two of the most expensive countries, that's India and the US, versus two of the cheapest, which is UK and China. So a lot of people, for example, have been saying, well, the UK looks very cheap, but the UK typically looks very cheap. So you always have to compare with its own history. Some countries just have lower valuations than others. If we compare countries by another measure, which is forward price to earnings multiples, and this is based on data from Yardeni, what's interesting is that we see a very similar pattern, with the US and India looking much more expensive than other countries. Italy, China, the UK and Germany, on the other hand, look quite cheap, just as they did with the CAPE measure. So this kind of corroborates the analysis we did previously and shows a similar pattern of expensiveness and cheapness. So contrarians, this should help you. Now let's look at US sectors. And just looking back over the course of 2023, you can see which sectors have done exceptionally well compared to others. And it's primarily technology, communication services, and consumer discretionary, which has done very well. So essentially, this is the tech story in the US. Communication services would include companies like Alphabet, and consumer discretionary, as we saw, would include companies like Tesla and also Amazon. So following the tech wreck in 2022, when a lot of these tech companies sold off sharply, 2023 is characterized by a resurgence in those stocks, whereas almost every other sector is simply languishing in the dust behind those three super sectors. Now, this usually means that those sectors will not continue outperforming in future. Usually it's the beaten up sectors which will then come on to perform better. So we can kind of ask the question, which sectors are currently looking overvalued and which ones are looking very reasonably valued? Because that might help us see where the opportunities lie. So what I've done here is I've taken the MSCI USA Value Index and I've looked at its sector composition versus its parent index, which is MSCI USA, just to see which sectors are overweighted because of the fact that they look attractively valued. They have reasonable valuations. So those sectors that we saw which had done incredibly well, which is information technology and consumer discretionary, those are underweighted in this value index because they're now expensive. Whereas the unloved and beaten up sectors like financials, healthcare, industrials, consumer staples, all of those have got an overweight in MSCI value. So this is just another way to see where the value lies in the US at the moment. It's certainly not true that all stocks in all sectors are expensive. Now let's look at gold. I find it useful to have an explanatory model for gold, which explains what its price kind of should be, given the state of various macroeconomic variables which drive its price. Now, if you're one of our premium members on our website, then you get access to these trackers, one of which is an explanatory model for the price of gold. So it's this fair value tracker that we're interested in. Now, what goes into this model is the level of CPI inflation, because commodities tend to track inflation over time, but also real interest rates, because when interest rates are high, gold is a wasting asset and that tends to drop its price. And also the strength of the US dollar against a trade-weighted basket of other currencies, because when the dollar's strong, then that pushes down the price of gold. It's priced in dollars. Now, what's interesting at the moment is that the price of gold isn't too far off its fundamental price based on a simple regression model with those inputs. It's underpriced by around 5%. We've got a similar model for silver, which shows that silver also is slightly undervalued at the moment. Now, if you are interested in getting access to the trackers, but also our community and lots of members-only content, and our chat application, so you can ask a question whenever you want. You can do that very easily by going to our website, PensionCraft.com, and that way you can learn more. And there'll also be a link in the description if you want to go there directly. Now let's think about corporate bonds. Now, corporate bonds are now interesting because the risk-free rate, which is what you'd get with a government bond, is now much higher. And then with corporate bonds, you get an additional spread on top for taking the additional credit risk. That's the risk that these companies will not be able to repay you your capital. Now, that could be a really attractive prospect if that credit spread was large, i.e. you got a big compensation for taking the credit risk. However, at the moment, that's not what we see. What we actually see is in line with what we see in the stock market, which is a bit of euphoria. What that turns into in the credit market are very tight credit spreads, very little additional compensation for taking credit risk. And that's true across the credit spectrum. Whether you look at AAA corporates, these are companies with fortress balance sheets, all the way down to single B corporates, which have slightly wobbly balance sheets and a much higher risk of default. For all of these different credit rating categories, what you'll notice is that the spreads currently are below their long-term average, denoted by this dashed yellow line. So at the moment, I don't think the opportunities in this credit market are particularly attractive. But if we did have a shakeout in credit, let's say there was a commercial real estate crisis or a big pickup in defaults, then there'd be a big sell-off, the credit spread would widen, and I think that could be a much more attractive entry point. So that's certainly something that's on my market crash shopping list. So if that happens during 2024, you can be sure I'll be talking about it. Now, at the moment, monetary policy is very important and a big driver of markets. And primarily, people are looking at what the Federal Reserve is doing in the US. So we've just come off a period of very aggressive rate hikes. The Fed is now in wait-and-see mode to see whether inflation is going to respond to its very tight monetary policy. And the fact is that it does seem to be responding. It is falling both as headline inflation and core inflation. The Fed is very reluctant to declare victory, but it does look as if 2024 will be characterized by cuts in interest rates beginning. So if we superimpose those Fed meetings over the course of 2023, you can see that for the first 3 meetings, we got 25 basis point hikes. That's a 0.25% increase in the Fed's policy rate. Then in June, we got no hike, we got a pause. And then in July, we got another hike. But since then, we haven't had any more. And in December, Jerome Powell said that it looks like we're at the end of the cycle. So probably no new hikes coming. We're probably at the top of the cycle. But if we do break down asset types to see how well they performed over the course of the year, what really stands out is the NASDAQ index. That QQQ NASDAQ tracker has simply surged ahead of all the other ETFs, which I've shown here. It's beaten gold, it's beaten real estate, it's beaten emerging market bonds, junk bonds, oil, short-term US treasuries, long-term US treasuries. All of those have been trounced by the NASDAQ, and to a lesser extent the S&P 500. Now, the NASDAQ is even more concentrated than the S&P in those magnificent 7 names, so I'd be slightly concerned about the sustainability of that rally. But if we do see monetary policy easing into 2024, then I'd expect a lot of the sectors which are now beaten up, things like financials, but also things which are very interest rate sensitive, like real estate investment trusts, and of course small caps, I'd expect those to recover somewhat and perhaps make up some ground that they lost over the course of 2023. Now, if we look at what markets are pricing in for the Fed policy over the course of 2024, I think they're a little bit too optimistic about rate cuts. The first one's expected in March, and then we get 1 rate cut for every following meeting, all the way up to September of 2024. Then there's a 1-month pause, and then the cuts start again. Now, that's completely at odds with what the Fed's saying, which is that it still hasn't declared victory, it's still going to keep policy tight for a while, it's only just started to talk about rate cuts. So March, I think, may be too soon. But eventually it's going to happen. The Fed's going to start cutting, and I think these beaten up sectors will probably recover as a result. It's always worthwhile looking at a longer term forecast, and we've got some here provided by Vanguard, both in the UK and the US. And these forecasts look out over a decade. So starting out with Vanguard UK's forecast, I think what's interesting here is that UK stocks aren't expected to perform particularly well. The 2023 mid-year forecast has uprated UK stocks slightly, so somewhere between 4.5% and 6.5% per year. That's the forecast return over the next decade. But But global equities look considerably better. There we're talking about a range between 5.8 and 7.8% per year. So I'm quite happy with my global equity tracker, which of course has this global exposure, and that's the only fund I own in my core portfolio. What's also interesting is if you look at bonds, they're now returning much more than they were just a year and a half ago, say. So UK aggregate bonds are now expected to return between 4.3 and 5.3% per year, which is quite respectable. Less than stocks, of course, but still not bad. And global bonds ex-UK somewhere between 4.3 and 5.3. Now turning to the US model forecast, what's really interesting is if you look at US growth stocks, they're only expected to return between 1.2 and 3.2% over the next decade. And that's because of their very high valuations. And this is the problem. When you have euphoria, usually what it means is you overpay for a sector or a particular theme. And Vanguard's model simply reflects that overvaluation. Whereas if you look at US value stocks, they're going to return something between 4.8 and 6.8% according to Vanguard's model. And again, global equities are probably the most attractive prospect at between 7.1 and 9.1% per year. And as I mentioned, US small caps are quite beaten up in terms of valuations. So again, there the return is expected to be between 4.9 and 6.9% per year. Bonds in the US too are looking more attractive with returns for aggregate bonds. So this would be a tracker of the aggregate bond index, say. That's going to return between 4.8 and 5.8% per year. So much better than we saw, say, a year ago. And if we look at US junk bonds, despite the fact credit spreads are very tight, because risk-free rates are now higher, they're expected to return around 6.4 to 7.4% per year, which isn't much less than the equity risk premium. Even US cash is expected to return between 4.1 and 5.1%. And while we're talking about long-term forecasts, let's quickly remind ourselves of base rates. These are the average returns over extremely long periods of time that you'd expect from stocks, bonds, and T-bills. So T-bills will generate roughly what you'd earn with a money market fund, say. Now, over the long term, if you look at the total return of stocks, in the US, they've generated about 6.4% above inflation for over 120 years. Now, that's an incredible inflation-busting return and something which should never be forgotten. Compare that with bonds, and on average, they earn about 4% less per year. So certainly for money you're going to set aside for a long period of time, decades, then it makes a lot of sense to put as much as you can into the stock market, because bonds will almost certainly underperform long term. And money market funds will generate the least risk, but also the lowest returns. So they really are a temporary store of value for your cash. I said we'd look at some analyst forecasts for 2024 for a bit of fun, and that's exactly what we're going to do now. Now, I often talk about a cognitive bias called recency bias when I'm talking about investors. But you can see that brokers working at investment banks are subject to exactly the same bias. So this is the S&P 500 since 2017. That's the blue line. And using the yellow dashed line, I've just fitted the average rate of growth of that index. Now the horizontal yellow lines you can see here are the end of year forecasts from the previous year made by individual investment banks. So the first set of forecasts we'll look at will be for the end of 2020 as made at the end of 2019. Now this was a scary period because it was during the pandemic. People were worried about the systemic problems in the market. The Fed had to do a massive intervention. And what's interesting is that they were far too bearish. In fact, the S&P ended up roughly in line with the highest forecast of all of the forecasts for that year. So too bearish in 2020. Then we got this incredible pandemania rally which extended into 2021. And again, the forecasts were too bearish, too gloomy. They just didn't price in all of that euphoria that retail investors mostly generated in the stock market. So in this case, the end of year was way above even the highest broker forecast from the previous year. Maybe learning their lesson from 2020 and 2021, brokers revised up their forecast very aggressively for 2022, just in time for the tech wreck, when things reversed. So for that year, the S&P ended up well below even the most pessimistic forecast for the S&P 500. So you can see how they just extrapolate the trend that we've seen recently. Then in 2023, they were too bearish again, and the S&P ended up above all of the forecasts at the end of last year. So looking forward to 2024, what you can see is that the highest forecast for the S&P is 5,400, the lowest is 4,200, and that corresponds to plus 14% as of the day I make this video for the S&P, or minus 11%. So a huge dispersion. And if we simply extrapolate the S&P 500 over this 7-year period and fit a line to it, an exponential line, that would put us at about 10% above where we're closing as I make this video. So that would be the upper end of the forecast from the individual brokers. Now, of course, this 11% trend growth that we see over this period since 2017 includes the period of zero interest rates. If we go back further in time to 1990, the growth rate diminishes to 7.9%. And again, extrapolating that would put us roughly at where we are now for the S&P 500. In other words, a year of no growth. And that would be roughly in the middle of the pack for the broker forecasts for 2024. So next year we can have another laugh about this to see how accurate those forecasts were. In conclusion then, I think the backdrop for stocks in 2024 is one of improvement. It looks like policy rates, certainly in the US, have pretty much topped out, and we're now thinking about cutting interest rates, which is good for stocks. The only worry is that it's going to stay higher for longer if we get a secondary spike in inflation. So it looks like the central case anyway is that inflation's going to be falling. The earnings recession is over for US stocks. That's good news as well. Valuations are still high for the US and India. That doesn't usually stop markets, but it does sometimes produce a bit of a break on returns long term if there's too much euphoria. So I think that is a moderating influence on returns. India too is very expensive right now. However, other regions, other sectors look much more reasonable. So US small caps, for example, the UK, Germany, Poland, many regions in EM also look quite reasonably priced. So maybe 2024 will be a chance for these left behind markets to kind of catch up with US growth stocks and the Magnificent Seven. So I'd say the central case is that rates kind of go sideways, maybe start to fall a little bit. Inflation generally starts to fall. And of course, here I'm talking about disinflation, not falling inflation, not deflation. So it's the rate of inflation which is lower. And if that's the case, then I think it'll be a good story for stocks generally, for global stocks, but also for developed market government bonds, because high inflation is toxic for government bonds. So if growth looks okay and inflation's falling, that would be good for bonds too. Probably what's going to happen is that growth will again start to perform well as it did in 2023. When interest rates fall, usually it's growth which outperforms, and that'll probably beat quality and value as alternative styles of investing. I'd say a tail risk is that we get something like a credit crisis, maybe triggered by the commercial real estate market in the US and elsewhere, which could spread out to the banking system, particularly regional banks, and the Fed could have to step in again to save the day. In that case, there'd be a pullback in risk appetite. That would not be good for stocks. Gold would probably do well. Developed market government bonds, again, would probably do well if there wasn't high inflation. And quality and income would probably beat growth as an investment style. So really it depends on which of those two things you think is most likely to be the outcome in 2024. So I hope that's given you a bit of help making up your own mind about what's going to happen to markets in 2024. Remember those base rates. Most of the time it's best not to rely on forecasts and to instead think about what happens to returns over the long term. So those 10-year forecasts I think are more important than 1 year ahead broker forecasts for the S&P 500 say. Now don't forget, if you do enjoy our content, please do subscribe to our channel and like this video. And don't forget our membership, our premium membership on our website. Just go to PensionCraft.com to learn more about that, and do join our community in 2024. And as always, thank you for listening.